All right, let's dive into a massive but kind of invisible part of the global economy, private credit. Something big is happening here. We're seeing a huge shift away from a decade of easy money and into a brand new era of discipline. Let's get into it. And this quote, it just nails it. For years, private credit felt like the Wild West of finance, a real party. But that party is officially over. What's taking its place is something way more calculated and honestly a lot more interesting. So, what are we even talking about here? What is private credit? Well, put simply, it's all the lending that happens outside the public eye. When a company needs a loan but doesn't go to a big bank or the bond market, they can tap into this massive $1.5 trillion world of private lenders. It's an absolutely critical engine for businesses all over the globe. To really get what's happening in the market now, we have to understand where it's just been. The story of private credit today is really a tale of two completely different times. So let's break down what caused this massive change. Okay, let's rewind the clock a bit. For the better part of a decade, the conditions were, well, perfect for some pretty explosive growth in private credit. And it created an amazing environment if you were a borrower. The key thing here is how all these factors just fed on each other. You had interest rates near zero, so money was incredibly cheap. Lenders were sitting on these huge piles of cash, what they call dry powder, that they were just desperate to put to work. This sparked this intense competition, which forced them to offer what are called covenant-light loans. Basically, loans with very few rules or protections for the lender. It was, no joke, a borrower's paradise. But, that kind of era couldn't last forever. A perfect storm of economic forces came along and just slammed the brakes on the easy money, creating this huge problem that the entire market is now trying to solve. And this brings us right to the heart of the issue, something the industry is calling the maturity wall. Just think about all those easy money loans that got handed out back in 2021 and 2022. Well, guess what? They're all starting to come due, and companies have to refinance them. The problem is they're trying to refinance in a world where interest rates are way, way higher. And the scale of this challenge is just enormous. We're looking at a huge wave of debt that has to be refinanced, like right now. It's literally a tidal wave of old, cheap debt crashing right into the new reality of expensive capital. Let's put a number on that. We are talking about an increase of 400 to 500 basis points. In simple terms, that's a 4 to 5% jump in interest rates. Now, for a company with a huge loan, that is a potentially crippling increase in their monthly payments. This is the shockwave that's forcing the whole industry to completely change its playbook. So, how's the market responding? Well, with a complete 180. The power has shifted. Lenders are back in the driver's seat, and they're bringing back a word that was almost forgotten over the last decade: discipline. And oh boy, has the pendulum swung back. Those borrower-friendly terms, they've been replaced by strict protections for the lender. Those covenant-light deals are out. And maintenance covenants, which basically give lenders an early warning if a company's in trouble, they're back in a big way. The whole mindset has shifted from growth at any cost to super careful underwriting and finding proactive solutions. But this new discipline, it's not just about saying no more often. It's about being smarter. Lenders are using all these sophisticated new strategies, like providing custom-made capital to good companies that are just in a temporary tight spot, or creating secondary markets to add more flexibility, or even lending against hard assets like machinery or intellectual property to get better downside protection. All right, I know these concepts can feel a little abstract, so let's make it real. Let's walk through a scenario to see how this new disciplined approach actually works when the rubber meets the road. So imagine a tech firm. They took out a €200 million loan back in 2021 when rates were at rock bottom. Their payments were totally manageable. Okay, fast forward to today. The loan amount is the same, but because the base interest rate, in this case Euribor, the European benchmark, has shot through the roof, their ability to actually pay that debt is severely stressed. And this is a perfectly healthy company facing a crisis created purely by the market shifting under their feet. So what does a smart lender do? Instead of just foreclosing, a disciplined lender comes in with a creative solution. First, they help with cash flow. They might convert some of the cash interest into what's called payment in kind, which just gets added to the total loan instead of being paid in cash right now. Second, they capture some potential upside by taking an equity stake, so they can share in the company's future success. And third, they align everyone's interests by requiring the founders to put more of their own skin in the game. It becomes a real partnership, not a punishment. Okay, so we've looked at the problem and we've looked at the new solution, but what are the real-world takeaways here? How does this shift from a wild, easy money market to a disciplined one actually affect investors and businesses? Right, so for investors, the message is pretty clear. Be really careful with funds that loaded up on loans from that 2021-2022 peak. You want to prioritize experienced managers who've been through tough cycles before and maybe look to diversify beyond simple direct lending. For borrowers, the best advice is to talk to your lenders early and often. And remember, sometimes flexibility in your loan terms can be more valuable than just getting the absolute lowest interest rate. And get ready to be an open book. Transparency is the name of the game now. Look, if you take just one thing away from all of this, let it be this. The game has fundamentally changed. Winning in private credit is no longer about just lending out as much money as you possibly can. From here on out, it's all about smart structuring, ironclad documentation, and having the control to step in and fix problems before they blow up. And that really leaves us with the big question for the future of this whole trillion-dollar asset class. In this new, much tougher environment, is all this newfound discipline just a tool for survival? Or is it the very thing that will unlock the greatest profits for those who can learn to lend the smartest? Thanks for joining us.